When you mention insider trading, most people immediately picture stolen corporate secrets and backroom deals in dark alleys. But the reality of the situation is quite different. The vast majority of insider trading happens every single day, completely legally. Regulators around the world actually require corporate executives to publicly broadcast their personal stock purchases and sales. This visualization shows thousands of global transaction data points. For decades, academic researchers have been taking these mandatory disclosures and funneling them into models that successfully predict future stock returns. Because we confuse a serious market offense with a strict transparency mandate, everyday investors are ignoring one of the most powerful analytical tools available in modern finance. To understand the data, you have to understand the law. Illegal insider trading happens when someone buys or sells a security based on material non-public information, meaning facts that would move the stock price, while breaching a duty of trust. Executing a trade on this hidden information essentially means rigging the game. You are securing a guaranteed profit or avoiding a massive loss before the rest of the market even knows the facts. The United States pursues these violations aggressively. The Securities and Exchange Commission routinely seeks civil penalties of up to triple the illicit profits, and the Department of Justice can secure prison sentences of up to 20 years for willful violations. Regulators globally share this zero-tolerance approach. The European Union requires member states to impose severe criminal sanctions for market abuse. Japan takes a highly rigid approach through its Financial Instruments and Exchange Act, deploying mathematical monetary surcharges designed purely to strip violators of any expected gains, offering virtually no leeway for negotiations. Authorities crush illegal insider trading because it destroys the core premise of a fair market, the guarantee that all participants have equal access to the same information. A legal insider transaction is a straightforward capital move. An executive uses personal, post-tax money to buy or sell based on information already available to the public. The dividing line between a potential felony and a perfectly legal trade comes down to one requirement: rapid, mandatory public disclosure. In the United States, Section 16 insiders must file a Form 4 into the SEC's database within 2 business days. The EU and UK utilize a similar framework. There, PDMR senior executives must notify the public of their trades within 3 business days. To prevent the market from being flooded with trivial data, the European Union applies minimum financial thresholds. National regulators can set this limit up to €20,000, filtering out the administrative noise of tiny transactions. Curious, with thousands of these filings hitting global databases every week, the question is, what does all this highly regulated, real-time data actually tell us about future corporate performance? This legal boundary effectively forces corporate insiders to act as real-time, involuntary broadcasters of their own financial confidence. When researchers parse this data, they find that legal buys and legal sells carry entirely different predictive weights and must be analyzed separately. Looking at decades of trading records, aggregate insider selling proves to be a terrible predictor of a stock's future decline. As this diagram shows, an executive's decision to sell splits into numerous administrative buckets. They might be diversifying their portfolio, selling shares to pay the tax bill on vested stock, or simply executing a pre-scheduled algorithmic trading plan completely disconnected from the current stock price. Contrast this with an open market purchase. There is an old market adage that there are many reasons to sell, but only one reason to buy. The executive believes the stock is mispriced and headed higher. These individuals are already heavily exposed to their company's success through their salaries and professional reputations. Voluntarily concentrating more of their personal wealth into the firm is the ultimate proof of internal optimism. While no single metric guarantees a return, you can use a research-backed checklist to filter this data for market context, though it should never replace comprehensive investment analysis. First, isolate opportunistic trades. Look for irregular activity and ignore routine transactions where an executive mechanically buys or sells during the exact same calendar week every year. Next, look at the title. Empirical studies show a distinct CFO advantage. Chief financial officers possess unvarnished insight into the company's immediate financial health, and their open market purchases historically yield better abnormal returns than those of the CEO.
This timeline illustrates the power of coordinated action, known as cluster buying. An isolated trade is a weak signal, but when the CEO, the CFO, and multiple board members all purchase stock within a tight 72-hour window, the signal strength multiplies. Finally, contextualize by firm size. This information gap is most exploitable in small capitalization companies, where institutional analyst coverage is sparse and the executive's knowledge advantage over the public remains vast. Understanding the legal boundary of insider trading changes how you view the market. It allows you to stop fearing the sensational headlines and start utilizing public disclosures as a precise, quantitative lens into the boardroom.